Well, let's move on and get another sort of perspective. Sameer Narang is now joining us. He's head economics research group at ICICI Bank. Pranjul Bhandari is chief India Economist at HSBC. Thanks very much, Sameer and Pranjul, for joining us on this important day. This is, of course, as we've been discussing, much harsh. What's been imposed is much harsher than what anyone thought. Let's just contextualize this for India. Sameer, if you can start first, what is your own assessment of what's the hit? It's, of course, very simplistic because there are negotiations, there will be give and take, etc. But on a static basis, what is the hit as you see it?
So, Prashant, as all of us know, we export around $85 billion worth of goods to America. Services is on top of that. And goods typically will have lower elasticity compared to services. So you should expect on the goods front perhaps a 10 to 15% impact directly on India's exports to the US, and that tantamounts to somewhere around, given our overall exports to the US, $8.5 billion to say something like $15 billion. So the base case impact in our sense is that should be around 0.3% of GDP. But as has been pointed out earlier by some of the panelists, that India should also benefit given the fact that tariffs on India have gone up less than what they have gone up on China, on Vietnam, and some of the other countries which are doing a lot of contract manufacturing. So ideally, we should be better off.
To that point, and we just had the management of Arvind with us, but you've got to start with the basic sort of cost of production as well, right? I mean, is there a big difference in some of these areas on cost of production, say textiles, footwear, etc.? I mean, are those countries much cheaper? So even the tariffs for them are rising more. I mean, is it a big advantage? Is it an advantage? Does it open up a window, as some are saying? Sameer, quickly.
It will, Prashant, because the cost of assembling these products in India will be far cheaper because the wage component will be a very significant part in any assembly work that is being done, including services exports. So given that, if we can get our infrastructure right, and cost of shipment is, and logistics costs are in line with the Asian countries, I think it's a very big opportunity because the 10 to 15% differential makes a lot of difference in terms of margins for the final retailers.
Pranjul, good morning. Thanks for waiting. What is your sense on some of the numbers? I'm assuming the numbers are what they are, but what's your perspective on how things will progress from here? Some have said this is an opening gambit, very maximum, highest cap, and then you kind of work back from there. Your thoughts, Pranjul?
Well, look, I must say that the situation is very fluid. If I come back to your channel in a few months, I'm sure, we'll be talking very different sectors, making very different points because things are changing so much. But I think my thoughts from what happened last night, number one, of course, it's come as a bit of a shock because, when I was seeing a lot of analysis around me, in a way, people were assuming a 10%, tariff addition to India, and it turned out to be more like 27%. But I think the silver lining, of course, is that, some of the other countries have got it even worse, ASEAN, China. So in a way, we're not doing that badly. So some sort of luck out there. But having said that, I think there's a lot of fluidity in a few things. Number one, in terms of which sectors are winners or losers. As in today, everybody's excited about pharma, but it's possible that something gets slapped on pharma, say, 3 to 6 months down the line. Today, we are not that excited about textiles or maybe electronics, but it's possible that, with the bilateral treaty, something sort of changes for textiles and it becomes a completely new opportunity for us. So this whole list of winners and losers are going to change dramatically. And I think that's going to bring a lot of uncertainty and volatility, into the markets. In terms of growth numbers as well, I think we need to think carefully between the direct impact on growth and the indirect impact on growth. My own sense is that, very simple back of the envelope calculation, 27% increase in tariffs across sectors, excluding pharma, can shave up about 0.5 percentage points from India's GDP growth. If you assume that some sectors are there in which the US consumers will take the hit, maybe it won't be 0.5, it will be 0.3 percentage points of growth drag in the short run. But I think this is not where the story ends. I think the second half of the story is more important. How much does global growth slow? And on the back of that, via second round effects, how much does India's growth slow? And one thing I'll be watching there a lot is FDI flows around the world, because they are a very good indicator of capex. If it slows across the board, it means that global growth, global investment is really falling. And the second round impact on India's GDP growth can actually be harsher than the first round impact. So I think these are the few things we need to think carefully about. Of course, our silver lining is that A, we have inflation which has fallen substantially. Our sense is that we'll have inflation below the 4% target for several months in a row, which gives a sort of long rope to the RBI to ease, something it's already done. I think we'll also see changes in its liquidity management facility. It's taken liquidity from deficit to surplus, but what we may see next is steps on how do you make this surplus a little bit more permanent in nature, so banks get the assurance and it actually adds to growth over time. So I think there's a lot of monetary policy easing that is there. The opportunity is there. And then the second big thing that India has, which a lot of other countries don't have, is services exports. It has not gotten into protectionism yet. It's rising very rapidly, at least right now. And that gives us this immense buffer, which many other economies don't have.
I think, I almost want to say shh to all of us, because who knows, right? I mean, services exports, God forbid if he starts looking there, then we have a real problem. So, well, fingers crossed. Hopefully, we're not going to go down that road anytime soon. But Pranjul and Sameer, just a quick question to take that point forward on the RBI's response to what we're seeing. Pranjul was talking about the liquidity measures anyway that the RBI has been unleashing. Durable liquidity is what it's all about. Sameer, comment on this. Do you expect any added measures over and above the prevailing domestic conditions and RBI's own liquidity mandate because of what's happening now with these tariffs? If you could quantify more liquidity steps, how many rate cuts, what are you expecting this year?
Well, the current liquidity framework, was started in 2019, operationalized in 6th of February 2020. And in that, the change from the previous framework was that the fixed repo facility, which was available to the banking system, was taken off. And it was desired that system liquidity should be in a little bit of deficit for effective monetary transmission. Since then, a lot has changed. Particularly, we have 24/7 payments. And banks have a preference to retain or hold some liquidity rather than, give it in the call money market. So in the current framework, perhaps the changes that would be required, as Pranjul was suggesting, would be operationalizing perhaps a fixed repo window in which banks have an on-tap facility which can be utilized anytime, and that will give them some comfort. It will also give a signal in terms of to the banking system for deposit costs to come down, because ultimately, unless and until deposit costs come down, for the system as a whole or for the economy as a whole, cost of borrowing on a durable basis is not likely to come down to that extent. So I think those are some of the steps on the liquidity front one should expect. We do expect RBI will continue to maintain positive, durable and surplus liquidity. And on the rate
cuts, rate cuts just very quickly.
25 basis points in April. Overall, I think given the impact of the current, tariff, there is a possibility that the RBI would like to also, change stance and give a signal that they would expect the liquidity surplus to continue. And this is a cycle on the liquidity and rate front, which will perhaps prolong for some more time.
Pranjul, April 9 expectations and beyond, rate cuts?
Yes, so we think RBI can cut a lot from here on. We expect 3 more rate cuts in the year. 1 has been done, so 3 more. Overall, 100 basis points rate cutting cycle. That's 1. The second is liquidity. It's been infusing a lot of liquidity, but I think over time, steps might be taken to make them more permanent in nature, as I was saying. Third is, regulatory easing. A lot of steps have been taken. For example, bank lending to NBFCs, all of that has been eased a bit. And our sense is RBI is sort of going to be a little easier on those fronts. And fourth, something which a lot of people don't really speak about, the rupee. I think it's good to see that the rupee, is looking like a more flexible currency at this point of time. I think this has a lot of benefits. And one big benefit is that if over time supply chains get rejigged and manufacturers want to put plant in India, they want to get assurance of a flexible, market-friendly exchange rate. So I think the fact that we've moved towards that direction is also positive for us. So I think on all these 4 fronts, I must say central banking, RBI will be the only game in town, in my view, for the next couple of months in order to lift growth. It's not going to be fiscal policy, because fiscal policy is tightening. And that's probably something good. We've taken it for granted because we have it. But, the countries that don't have macro stability are paying a price for it in terms of market turmoil. Thankfully, we have fiscal, which is showing market discipline and macro stability, and monetary policy, which is supporting growth and is easing. So we have this very nice combination of growth and macro stability, which is to our favor, in this whole world of global storm.
All right, storm it is, and no one wants to touch that. The fiscal stability and, of course, lower bond yields, etc., all a consequence of that. But RBI, 9th of April, of course, rate cuts expected, perhaps assurance that liquidity will remain ample. Thank you very much, Pranjul, for joining us. Sameer, good to see you back on the show. And we will chat again. As Pranjul, you said, next time we speak, I think things will be different, and how different we'll have to see. But thanks once again. Both